Accountants are responsible for ensuring that organizations report their finances in an accurate and standardized manner. This responsibility can lead to legal and ethical dilemmas for accounting professionals, and some of the biggest corporate scandals in history have been due to accountants' failure to adhere to the ethical requirements expected of their profession.
When an organization is not performing, leaders may be tempted to pressure accountants to manipulate the figures and influence the perception of the company's performance, so as not to cause panic amongst investors, staff, and other stakeholders. Lehman Brothers, the global financial services firm, did just this in 2008. In cahoots with Ernst & Young, their auditors, they misrepresented over $50 billion in toxic loans as sales. Investors lost all their money when the company abruptly went bankrupt. Failing to accurately report the financial status of an organization can lead to civil or criminal charges, and many accountants fall prey because they fear losing their jobs or clients.
The flip side is sense of omission, when accountants feel pressure to leave things off the financial reports, so it does not paint the company in a bad light. The Enron scandal of 2001 saw the former and current CEOs colluding to deliberately keep huge company debts off the company's balance sheet. Arthur Andersen, Enron's accounting firm, was found guilty of fudging the company's accounts.
Using sensitive information incorrectly or failing to protect confidential information are both ethical issues for an accountant. Using confidential information to take advantage of an upcoming growth or drop in a company's value or insider trading is an example of this.
Conflict of interest is one of the trickier issues to identify. If senior accounting staff receive bonuses based on a company's stock prices, they are motivated either consciously or unconsciously to make decisions in favor of higher stock prices, even if, in the long term, it would not be good for the business or investors. The final ethical dilemma relates to whistleblowing and knowing when it is the right time to bring in external investigators into a company. This could cause a company to fall or lose significant stock value overnight, hurting thousands of investors or causing the accountant and his or her co-workers to lose their jobs. There is a very real risk of backlash and intimidation, and earning a reputation as a troublemaker.
So how do you make difficult yet principled decisions when faced with these dilemmas? You can check if the issue is covered by a law or policy. Most certification bodies for accountants have a code of professional conduct or a code of ethics that gives guidance on what to do. You can separate the issue from your personal and professional feelings, which can help to see it in a different light. You can identify the parties who will be most affected by the issue or by your decision to take action or not to take action. Remember that failure to do the right thing can have just as much of an effect as being the perpetrator of unethical behavior. You can get professional advice either in-house or through an independent firm. All organizations should have a code of ethics and standards, and if your organization does not have one, then you and your team should strongly advocate for one. While it will not necessarily provide a solution for every scenario, it will act as a guide in your decision-making process. You can ensure that your company has policies in place that enable employees to disclose their personal dealings to avoid conflict of interest.
Robust and corporate governance structures ensure that accounting and audit units can be objective and are able to carry out their work without fear of victimization.